If we could have the panel up onto the stage, that would be great. My name's James Doveridge. I've been looking after everyone in this room this morning. We are now moving on to another panel discussion on public equities, and is this an exceptional point of entry into the marketplace in Africa. Joseph Ron will be moderating this panel. Joseph's the managing director and co-founder of Ventis, which is an African-focused investment firm. He's managing the portfolios there. He's previously worked over 20 years with Investec, Repricing in Africa, and ABN AMRO. As you can imagine, we've got a fabulous panel, but with that, I'm going to hand over to Joseph to control and moderate. Thank you.
Thank you very much, James. Just by way of brief introduction, so a big thank you to the panel for joining us today. We've got three experts in public equities. Firstly, Ayo Salami, Chief Investment Officer of Emerging Market Investment Management. Thea Jamison, Managing Director and Founder of Change Global Investment. Thank you for joining us today. And David Grayson, Chairman, Chief Executive Officer, and co-founder of Auerbach Grayson. Maybe just by brief way of introduction, the three of you can just tell us how you connected to the African public equities market, and just a quick word on your business and your firms.
Okay, thank you very much, Joe. So I'm the Chief Investment Officer at MM, Emerging Markets Investment Management. We run an Africa-focused equity fund, which was set up in 2007. So we've been investing in African public markets for about 12 or 13 years now. And it's mainly our investment strategy is based around looking at the same typical things most people will look at in Africa: urbanization trends, telecommunication companies. It's a bog standard fund, and most of our investor base are primarily European pension funds.
Hi, Joe. Maybe just a quick word on Change and what your focus is.
Sure. So I have been investing in emerging markets on behalf of institutional investors for nearly 25 years. I've built out emerging market strategies within large firms, and I have built new firms from the ground up. I founded Change Global in 2013 with the notion that there's a very consistent source of alpha in the public markets. And as such, I felt important to build the proper culture and operating environment. We manage on behalf of institutional investors, primarily based in the US, such as public plans, foundations, and endowments. And we manage global portfolios in the developing world. Africa fits in very well into this profile because it accounts for roughly a third of our global exposure. So it's definitely a differentiated and a very significant exposure for us.
David, maybe just a quick word on yourself and Auerbach Grayson.
Sure, Joseph. So we are a US-based global stockbroking firm that specializes in selling non-US equities to not only North American institutions, but a number of fund managers in Europe, the Middle East, and Asia. So 99% of everything we do is US dollars leaving the United States. We're in 120 markets around the world. In terms of Africa, South Africa, when we began the company in 1993, our vision was only to develop Europe, and we accidentally got involved in South Africa as the sanctions were being lifted. Mandela had got out of prison, and there was huge interest in South Africa. So in the days of before email and internet, I got on a plane and just started flying around Africa and building a network of brokers. So today we're in every country in Africa with a capital market system, 17 countries plus the 18th being the BVRM based in the Ivory Coast, but covering 8 of the French-speaking countries of Africa. So we think it's a terrific opportunity.
Thank you. I should just add at Adventus, we have a public equity fund that is very focused on impact investing in Africa. So that's our core focus currently through public equities. We'll come on to discuss that in more detail. But the question that I'm probably asked most frequently at the moment is just how resilient African markets have been through this pandemic, and how have they performed relative to other frontier or emerging markets, and how they position currently looking forward from here. Maybe, David, I can start with you. Any thoughts on the resilience of African markets through and coming out of the pandemic?
I don't think any market or any country in the world has been, including the United States or the UK, has been completely resilient to the pandemic. And people like to group Africa as being one market, but it's not. It's not the United States of Africa. Each country has its own culture, own language, own story, own view towards capital markets and public ownership of securities. But I would say overall, a generalization is that for the most part, each country has suffered somewhat from the pandemic and then has come back out of the pandemic, or at least perceived to have come back, even though they may not have. So put another way, what I'm saying is that sitting here in this room today or visiting London, or if you drop into New York, you'll feel that there's no real pandemic anymore. But in Africa, it's certainly very much going on. Such a low percentage of the population is vaccinated, so it's going to take a long time for Africa to bounce back. But if you're looking at investments, I think the bottom line is you have to be country specific and company specific, or vice versa.
Thea, anything you would like to add? Because you look across a number of different frontier markets as well.
So I think strictly speaking, relative to the market expectations and specific to investment returns, Africa has been more resilient than expected. The questions that we had to address in March of 2020 indicated a significant amount of concern by investors in the US as to investment returns, prospective investment returns. And I think standing here today, I'm pleased to share that the returns have been good. I think the surprise has come in from the local investment community as a result of the new market environment and historically low interest rates across Africa. We've seen domestic investors rise and come in strongly in several of the markets to support bottom fish and really invest for the coming years.
Aya, anything you would like to add?
I mean, I think, I would concur with what both David and Thea have said. When you look at the impact of the pandemic, I suppose we have to separate it between the economy and the financial markets. In March last year, when the pandemic hit, there was a general expectation that Africa was going to be severely impacted by this thing, because you had governments with weak fiscal balance sheets and very, very weak and health systems. That how was the continent going to cope with this pandemic if this thing? And if you were looking globally at where you would expect to see the highest rates of death from the pandemic, Africa would have been would have been right there at the top of the regions that would have concern. We move forward almost 18 months later, and Africa, the number of cases might be high, but the fatality of the pandemic in Africa is actually negligible. If you exclude South Africa and Egypt from the data, the excess death numbers don't actually move in a lot of the continent. And that has been surprising, and I'm sure when the pandemic is over, People are going to do, epidemiologists are going to do PhDs on this topic to try to understand why was the death rate so low in Africa. There are competing theories for it, but the reality is that it actually hasn't had that much impact. The second thing about the economy is when you look at the counter-cyclical fiscal measures that we're taking globally, a lot of governments spent a huge amount of money to counter this pandemic. Globally, in the G7 countries, it's about 9% of GDP. The figure for Africa is only 1.5% of GDP. They didn't have that much money to spend. And yet when you look at the GDP growth rates, the drop in growth rates and the negative impact of on domestic growth, the African number is actually quite commendable. GDP dropping by about 3% when you've only spent 1.5% in counter-cyclical spending. And then in the developed world, you have a drop of almost 6% when you've spent almost 9% in counter-cyclical spending. All these start to demonstrate the robustness of the domestic economy. Then we come to the financial markets, and there it's a different story. Because the markets themselves have been resilient, but they've underperformed the rest of the world. But that's a simple thing to understand, because the growth that we've seen since March last year in financial and risk assets in the developed economies has been primarily driven by quantitative easing. The huge amount of wall of money that has hit these markets has not actually gone into the real economy, it's just gone into inflating the value of financial assets. But you've not seen the same level of quantitative, monetary expansion in Africa, and so the relative performance of African markets start to look like. But when you look at the fundamentals, corporate earnings, the things that matter, are the companies, what's the growth in corporate earnings, what's the growth in corporate sales? Africa actually looks just good. It looks just as good as any other part of the world.
Okay, I think just changing tack a little bit, changing focus a little bit. So we've heard about how Africa has come through in a fairly resilient manner through this crisis, a lot of different moving parts. But when you come to a conference like this, there's a lot of focus on private markets. Be interesting to hear from the three of you the relative attraction of public equities versus private equity or private investing in general, and the case for public equities in Africa. Maybe I can start with you, David.
Well,
and it's not a fair question. You're not a private equity investor.
No, but it's okay because I have my view, but it might take me 30 or 40 minutes to answer the question. Again, I'm answering the question a little bit indirectly. Going country by country, some countries I think are great places to invest, but have dormant or illiquid public markets. So Rwanda is my favorite example. It's arguably the cleanest, most well-run, overall, best-run country in Africa. Probably some people who are going to disagree with me. But the market is illiquid. There's no proper custodian tied in. The government recently listed the brewery, when I say recent, in the last couple of years, a brewery and a cement company, but they were listings, they weren't even capital raises. So the problem is in markets like Rwanda and others is how do you invest, and the way is through private or private equity or FDI, and I think that's actually an area that is growing in Africa, and there's certainly a lot of opportunities. Our business, yes, is solely in public equities, although we do some things in the private space. And the other, I'll wrap up in a second, but the other problem is that in many of the countries of Africa, there's a cultural problem, which stems possibly from the governments too, because people, they have not developed a domestic group of investors who understand that they can invest in the market and own pieces of companies and make money. Yes, they can lose money too, but the idea is to choose wisely and make money. And the government, you know, from my point of view, there's no better, more transparent, legitimate way of raising capital than through the public markets.
I think one of the key challenges has been the lack of private equity exits. They're trade sales as opposed to IPOs. And therefore, on the public side, we just haven't seen the growth of the capital markets that we really would have liked. But hopefully, you know, that has started to change, and hopefully that accelerates. But maybe just going back to the public versus private discussion, Thea, I don't know if you have any strong views on, you know, the relative attraction of public markets in Africa.
I do have a very strong view, and it's a part of our marketing presentation, because I feel that the inconsistencies in investor behavior today point to a very large and significant opportunity in repricing in the public markets. We have attempted to get a sense of the valuations on the private side, and based on public materials by some of the large consulting firms, it appears that in Africa those valuations are running in the mid-teens EBITDA range. In the public markets, we're finding blue chip companies with established businesses, track record, management, governance, liquidity, and lack of leverage at a third the valuations that we know of in the private markets. Historically, that was reversed. Public markets traded at a premium to private for all of the issues and hurdles in private. But today, at the tail end of a very long bull market in the private markets, it seems that the opportunity set has reversed. So for us, it is, we do have a very strong opinion on it, and we see our job as educating the institutional investor base in America on this discrepancy and truly pricing inefficiency.
Thank you. I think one of the challenges is not only that relative valuation of public to private, but within the public space, if you're a US investor looking at S&P performance relative to African performance, Africa has disappointed, and that's been over a long period of time. So maybe I can ask you, what changes that, and how attractive? I mean, Thea touched on how attractive valuations are, but in your view, you know, what are valuations at the moment, and what changes that?
Valuations, I mean, cheap does not begin to describe it. Valuations are dirt cheap. Just to go back quickly to the point that here I emphasized. I mean, we're getting African fintechs today, which have no prospect of making any profit in the next 5 years, trading at valuations higher than the largest bank in their domestic markets. You know, I mean, Nigerian fintechs are trading at valuations bigger than the valuation of GT Bank. GT Bank makes $300 million profit a year. I mean, I don't think these fintechs will make $300 million in my lifetime, but you know, but they are valued higher than an established bank which makes a small amount of money. But yes, Africa has underperformed. But I mean, you know, it's one of those things where we say it's statistics. It depends on where you start from. If you start from 2010. Undoubtedly, as an asset class globally, Africa has underperformed. If you start from 2000, the numbers change radically. People today look at the global equity markets, and we are all very short-sighted, and we're looking at the recent performance of the S&P. From 2000 until 2010, the S&P went nowhere. Mm-hmm. You know, it was completely dead. And so if you start in 2000, Africa actually outperforms. Mm-hmm. I mean, you know, the annualized return from the S&P from 2000 until to date, including the massive valuation uplift from quantitative easing, is 2.5% a year. That's all. Mm-hmm. People forget, it's from 2000 to today, it's just 2.5% a year. From 2000 until 2010, the S&P was massively negative. Whereas if you looked at Africa from 2000 to today, it's 4.5% a year. So we've outperformed by 2% a year over a 20-year period. If you look at it over a 10-year period, we underperform. Over a 20-year period, we've outperformed. And then what you have to now look at is what's the runway for earnings. What we've seen is that the S&P has moved, but it's been entirely multiple expansion. Mm-hmm. It's not been earnings growth. It's not been that earnings have doubled in the S&P to justify the fact that the company, the valuation has doubled. It's trading on massively expanded multiples. In Africa, earnings have kept up, but valuations have gone down. And so you've had valuation compression. And that is now gives you the opportunity to be able to buy African companies today on single-digit PEs when they're generating double-digit earnings growth. And it's nothing that the companies are not bad. Their ROEs and other fundamentals, EBITDA margins, are comparable with any that you're going to find anywhere in the world. But today, it's, I don't. If you're buying Google and Facebook, I don't blame you. But you have to, coming from, before I started fund management, I used to be an academic. One thing we know about financial markets is mean reversion. Things will they will come back towards the mean. And at some point in time, there will be a change. There will come a day again when it will matter what your PE is, what your ROE is, what your EBITDA margin is. And when that day happens, a lot of you will find out who's, as Warren Buffett says, who's swimming naked. I don't think there are many companies swimming naked in Africa today.
That's exactly right.
And Thea, what do you think gets public equities in Africa moving again?
Yeah, so I referenced to the first catalyst that we're seeing play out, which I think is actually playing out sooner than we would have anticipated, and that's the rise of the local investor. In the long run, it's a very simple story. The financial resources are growing much faster in Africa domestically as opposed to in the West. So while the assets are in the West today, in the long run, that investment will be driven primarily by local institutional and retail investors. And these are the facts pointed to by McKinsey or Pricewaterhouse, any of those major organizations. In the short term, though, we have started seeing local investment come back to the equity markets, really starting in 2019. When monetary policy started normalizing in the Western world. And if anything, the pandemic has amplified that move. And it has to do with the investability or the investable options on the ground. Prior to 2019 and certainly the pandemic, real rates were quite high and attractive for local investors and corporates alike. And therefore, there was little incentive to take the public equity risk. With rates coming down to historically low levels, there is a real incentive to start moving, at least on the margin. So we've seen that first wave really move the markets, and it's accounted for the first leg of recovery. The second catalyst that we're seeing play out, especially with the strong blue chip companies, that are not swimming naked, in your words, is the changing capital allocation models on the corporate balance sheets. Just as local investors prior to 2019, 2020, the local corporates tended to invest the excess cash in fixed income instruments. The average blue chip in Africa does have a net cash position. That's one way that it differentiates itself from investments in China or India. The African blue chip is actually a very healthy corporate. And now with interest rates being low, we're seeing a big shift towards share repurchases. This is something that's very new in Africa. It's very new for emerging markets overall. It is, we feel, here to stay for some time. And then the last sort of catalyst or market participant that's likely returning is the foreign investor. We've seen certainly within our organization, but also the EPFR data is indicating that there is a return of foreign capital to those markets. It tends to lag, but as they continue seeing these good returns coming through, those investors will be coming back.
I think that's a point that's often missed, is the growth of domestic pension funds in Africa. 10 years ago, they were almost non-existent. And I think they will add stability to these markets and help dampen a lot of the volatility that we've seen in the past. And hopefully, as you suggest, there'll be more allocation from fixed income to equities within the domestic pension fund market. So that's a specific point I would just reiterate. David, maybe just to ask you about currencies, and outlook for currencies. And I think one of the biggest frustrations for public investors is the Naira and the inability to move Naira in and out of Nigeria, given it's such a big market for us on the public side. Just be interesting to get your thoughts on currencies, outlook, what your clients are saying currently.
If you don't mind, I just have to respond to something that Thea said first, because she made a great point about domestic investors as a way of getting more liquidity and more activity in the markets, divided between retail and institutional. So one of the ways of getting more local institutions, pension funds involved, is to do what they've done in some markets, not only in Africa, but around the world, is you require the local institutions to invest a certain percentage of their assets in the equity market as opposed to just fixed income. And the other way is retail investors. The importance of retail investors is every retail investor in the world thinks they're smarter than professional investors, and they probably are. But the point is there's the contra theory where the retail investors buy when the institutions or foreigners selling. So that's something that adds overall liquidity in the market. But what it comes back to is something at the top. They still need product. They need companies to invest in. So the governments need to privatize, right? They need to make company managers and public company shareholders, because there are so many markets, and I can name them, where it's just not part of the culture. You're a foreign investor and you want to go visit a company in the BVRM, good luck. Maybe you'll get an appointment booked the moment you arrive, and it's because they're not motivated to speak to foreign investors. They don't understand the value of raising raising the profile of their shares. One case study which I find very interesting is in Ghana, when the Ghanaian government issued the license for MTN Ghana, for the mobile phone company. They stipulated that within 5 years, the company had to go public and be listed on the local stock exchange. The company, again, management was not shareholders. They kind of dragged them kicking and screaming to the stock market. But part of the mandate, and full disclosure, we were the only foreign broker on the deal, but full disclosure, in actuality, the retail investors to invest could only invest through an app on their phone, which I thought was pretty clever because that gets them used to investing. It was a very successful IPO. Again, I think it was 3 or 4 years ago. The performance is just under 200% increase. But then there's been no follow-on offerings. They're not just in that, but in that particular market. There's an IPO going on in Namibia right now. Again, a small, semi-dormant market, population under 3 million, for the local government-controlled phone company, MTC, which hopefully will also add some liquidity to the market because it's, for the most part, only being offered to local domestic investors. Back to answer your question in a nutshell, yeah, I mean, the NIRAD is a big problem. It reminds me of what happened in Egypt 5 or 6 years ago when you couldn't get dollars out and investors just turned their back on the market, and it took years to get the confidence back into the market so that foreigners would invest. Ultimately, the government created a fund to guarantee that foreigners could get their money back. Nigeria should do the same thing. If there's a country in Africa that needs help with their currency, among other things, it's Zimbabwe. I mean, we used to do huge amounts of business in Zimbabwe. So the government's answer to that was create another stock exchange, the Vic Falls Exchange, where they only trade in dollars. But what about all the money sitting in there? And unfortunately too, Joseph, part of this, as I said earlier, it's not the United States of Africa, but in a way it is, because it paints a negative picture and makes it difficult when there's a failed currency, a failed deal. It reflects on the whole continent. So it's too bad that there's also not more planning among the finance ministers or head of the central banks in trying to control and make more attractive to foreign investors, because for the three of us sitting here, those are things that are all important. And one other point is Africa's competing, I mean, they're all emerging and frontier markets. They're competing against emerging and frontier markets in Asia and South America and other parts of the world. So you'll have other investors who will say, well, I can't be bothered. I got burned in Nigeria. I'm going to go on to Vietnam.
So we've talked about some of the challenges, and fortunately, I think foreign reserves in Nigeria are starting to grow quite significantly again. So hopefully we're at the end of certainly the Naira challenges. I mean, it's in the previous panel we talked a little bit about, or they talked a little bit about opportunities. Io, it would be interesting to hear from you within your funds. What are the really exciting areas that you are focused on? Where do you see the really big opportunities in Africa currently?
I mean, in terms of the public markets, the biggest opportunity at the moment is just the valuation, the low valuation of these markets. The average PE for African markets today is somewhere around about 7.5 to 8. And
lower than the dividend yield.
Yeah, that's exactly the point I was about to make, is that, and the average dividend yield is now getting close to around 9-10%. I mean, when I was a student studying financial management, the rule was the dividend yield is 1/3 of the PE ratio. Now you have markets where the dividend yield is higher than the PE,
Very
the dividend
unusual.
And that's a very unusual thing. And I mean, Thea made the point earlier that it's going to come, I mean, the re-rating of the markets will have to come from local investors. And I think we're getting to that point where the crossover between the return on dividends, the dividend yield, and your fixed income returns are almost looking at a par now. I mean, in Nigeria, you get more dividend yield than you get from investing in domestic T-bills. And so I think we're initially going to have a re-rating of these markets. They are long-term, they are now trading more than 2 standard deviations away from what used to be their historical valuation levels. So, I mean, historically, I would have expected Africa to have a PE of around about 13. Today, it's sitting at a PE of 7, 8. So there will be a re-rating there. And then after that, we would then be back to the same story we had before the pandemic, which is, you have, rising income levels, which have remained roughly, reasonably resilient. In terms of sectors, I don't think you can find anything cheaper than an African bank today. I mean, I've not, banks, a really expensive bank in Africa trades on a price-to-book ratio of 0.5. So, their price-to-book ratios are ridiculous. And it's nothing to do with the performance of the banks. These are banks with very strong capitalizations. Tier 1 capital adequacy ratios of around 17%. Return on equities, which are greater than their cost of capital, but they are trading on a price-to-book ratio below 1. Doesn't make sense. I mean, if your return on equity is greater than your cost of capital, at the very least, you should trade at a PB of 1. Even if we are, so what that means in a lot of banks in Africa, you could write off the entire loan book and you still don't get to the net, the share price still doesn't reflect that. And then it would then go back. The telecommunication companies are also a very, very exciting sector. I mean, they've actually been very robust and done exceptionally well. A fintech in Africa is a telco. It's a bank or a telco, that's it. And then the other sectors, it's a simple market to understand. I always say it's a BBC, bank, brewery, cement. That's it. You buy a bank, you buy a brewery, you buy a cement company, you're done. And if you want to put a T at the end, buy a telecom company. Any one of those sectors they've still all got very, very strong growth. But there is an initial opportunity for a repricing just on the basis of the fact that they are very, very cheap markets today.
I just want to leave time for question at the end, but Thea, maybe just a concluding remark from you in terms of
I'm just going to add to
opportunities.
his comment because I think it's important from a global investment perspective that exposure to Africa in a more meaningful way does help. It improves the portfolio characteristics, it improves the upside potential by bringing down valuations, but also just as importantly, which is something that we haven't discussed, an investor, a global asset allocator can very effectively manage risk as defined by standard deviation because you're adding exposure to highly uncorrelated assets. And I think that that's something that institutional investors will be looking at more going forward.
And that low correlation is actually held and continues to hold over a very long period of time. And I think that's probably one of the strongest cases for investing in public equities. So just before we conclude, I don't know if there are any questions, anybody has anything specific they want to ask with regard to public equities? So thank you to the three of you. That was very interesting, and appreciate your time on the panel today. Thank you very much.
Thank you.
Thank you. On behalf of everyone, if I can thank you for moderating and the panel. It's been fantastic.